Hi everyone. Today we're going to explore an important financial instrument called a swap. You may already know about forwards and futures, but swaps are another key tool businesses and investors use to manage risk and take advantage of market opportunities. A swap is a financial agreement between two parties to exchange, or swap, streams of cash flows over a specified period of time. These cash flows are calculated based on a notional principal amount. The word notional means that the principal isn't exchanged. It's only used as a reference for calculating payments. Swaps are most common in interest rates, currencies, and commodities, and they're usually traded over the counter, which means privately negotiated rather than on an exchange. Here are the main features of swaps. Cash flow exchange. Typically, one type of payment is swapped for another, for example, fixed versus floating interest payments. Customization. The terms, like dates, rates, and amounts, are fully negotiable between the parties. No upfront payment. Unlike futures or forwards, swaps usually don't require an initial investment except for transaction costs. Counterparty risk. Since there's no clearinghouse, there's always the risk one party may default. Now let's look at the major types of swaps. Interest rate swap. One party pays a fixed rate, the other pays a floating rate, often tied to LIBOR or SOFR. Currency swap. Parties exchange cash flows in different currencies. Very useful for international firms. Commodity swap. One side pays a fixed price for a commodity, while the other pays the floating market price. Credit default swap, CDS, works like insurance against default. One party pays a premium, and the other compensates if a borrower defaults. Here's an example of an interest rate swap. Company A borrowed money at a floating interest rate, so it worries rates might rise. Company B borrowed money at a fixed rate, so it worries about missing out if rates fall. They make a deal. Company A pays Company B a fixed 5% annually. Company B pays Company A the floating LIBOR rate. Outcome 1. If LIBOR rises to 6%, Company A benefits. It pays 5% but receives 6%. Outcome 2. If LIBOR falls to 3%, Company B benefits. It receives 5% but only pays 3%. So, why are swaps important? They're used for risk management to hedge against interest rate, currency, and commodity risks. They offer flexibility since contracts can be tailored to specific business needs. They're also crucial in global finance, especially for multinational corporations. And yes, like other derivatives, swaps can also be used for speculation. That's the power of swaps, an essential building block in modern financial markets. This concludes our discussion about the swaps. Thanks for watching, and I'll see you in the next lecture.